So, good afternoon and welcome to the 711th meeting of the Economic Club of New York. I'm Barbara Van Allen, President and CEO of the club. And as many of you know, the club's been recognized as the nation's leading nonpartisan forum for discussions on economic, social, and political issues. We've had more than 1,000 prominent guests. Speakers appear before the club over the last century. And so we have a very strong tradition of excellence, which continues through to today. I want to welcome students from Rutgers University, CUNY Graduate Center, and Mercy College, who are joining us virtually. And we also have some members in the room from our largest ever class of fellows, the 2023 class of fellows. The fellows represent a select group of diverse, rising, next-gen business thought leaders who have been nominated by members of the club. And we've just been delighted with the growth of that program over the last 5 years. Is that a noise? We'll continue. There we go. I'm honored to welcome our special guest. I think Marc Rowan. And Marc is the Chief Executive Officer of Apollo Global Management. He is currently serving on the board, of course, of directors of Apollo Global Management. I'm sorry about that noise. That's unfortunate. Athena Holding Ltd. and Athora Holding Ltd. He's also chairman of the board of advisors of the Wharton School and a member of the University of Pennsylvania's Board of Trustees. In addition, he's involved in public policy. He's an initial funder and contributor to the development of the Penn-Wharton budget model, a nonpartisan research initiative which provides analysis of public policy's fiscal impact. He's an active philanthropist and civically engaged, a founding member and chair of the Youth Renewal Fund, and vice chair of DARCA, Israel's top educational network, operating 45 schools with over 25,000 students throughout its diverse and underserved communities. He's an executive committee member of the Civil Society Fellowship, a partnership of ADL and the Aspen Institute designed to empower the next generation of community leaders and problem solvers. He graduated summa cum laude from the University of Pennsylvania's Wharton School of Business with a BS and an MBA in finance. The format today will be a conversation. We're delighted to have co-anchor of CNBC's Squawk Box, Andrew Ross Sorkin, doing the honors of moderating. As a reminder, this conversation, which will begin in a minute, is on the record, and we do have media on the line and in the room. Time permitting, they're going to take audience questions from those in the room. So let us now bring them forward to begin the conversation.
Thank you so much. Thank you for being here.
Total pleasure.
And we'll see whether we do better or worse with the soundtrack. But I think we'll get past it.
Apollo is a noisy place.
It's a noisy place.
I'm not worried.
And I got some noisy questions, so we'll see how we do. Here's what I want to do. I think there's sort of three buckets I want to talk to you about if we could today. One is sort of the environment. I think we're all trying to make sense of where we really are and what's happening. The other is Apollo itself and the world of finance. And then a little bit about you. And that's sort of my order of events, if we could. But
I'll delay along on the first two so we never get to the third.
Okay, that's what the politicians know how to do, and we'll try that. But just help us with this. I think everybody in this room, given the uncertainty in the world, and we're looking at bank crises or not, we had the debt ceiling that's no longer a crisis, and everything else and what the Fed may or may never do, where do you really see us right now?
I see us as having a non-recession recession, which is always dangerous with our chief economist sitting next to me.
Is that a house view or is that a Rowan view?
I think it's a house view. I'm looking for assent there, but it's not illogical. I mean, think about how we got here. We had a financial crisis. We completely changed the rules of how financial markets worked, but none of us noticed because we printed $8 trillion and we lowered interest rates and everything went up and to the right. Stocks went up and bonds went up and real estate went up and wine went up and cars went up. And if it could go up, it went up. Okay, we're at the end of that. Nothing along the way created excesses in the economy, created excesses in financial markets. So I look at where we are today. We're going to have, those of us who deal in financial markets are going to feel like we had a real recession. More to come. Those in
financial markets, you're going to feel a recession.
And that's what I mean by a non-recession recession. I just don't see any sign in the underlying economy of the kind of demand destruction that is going to put unemployment, back to levels we would really think about as recessionary. I mean, we were at 3.4% unemployment and people are talking about, oh my God, 4.5%. That used to be full employment like a year ago. And I think that's exactly where we are. I just see no sign of the kind of demand destruction.
Are you surprised, though, just how strong demand has been, how strong the consumer has been, and strong employment has been? And if you think you need to get inflation under control, and I don't know if you do, what kind of destruction has to happen to get there?
I just don't think we know yet. So I think the roll through of very high rates, 500 basis points move over a really short period of time is going to take time. It's going to take somewhere between 12 and 24 months to roll through the economy. It will eventually reduce inflation. Inflation seems to be rolling over in many instances anyway. But I just don't think we know at this point. But I see no sign of, yes, we're going to have a recession. We're going to have 2 quarters of negative growth, if only because inflation is going from 8 to 4. Last I looked, that's negative growth.
Do you think we get to 2?
I'd be shocked. But if we get to 2 before an election, which will keep us from getting to 2.
And what do you think to get to 2, what kind of unemployment you think you'd need to have?
I just don't know. But I just don't see us anywhere close to real demand destruction to get to what I would consider a traditional unemployment level recession. And
so given that, both in terms of the lending business that you're in and also the PE business that you're in, what are you even doing?
Look, we do what we always do, which is we're very optimistic people. Let's start with that. But we're very negative investors. We come with one strategy, which is purchase price matters. And so we assume things are going to get worse. And there are lots of reasons we can assume things will get worse, having nothing to do with the economy. Geopolitics, politics, regulatory change, technology change, cultural shifts, and everything else. The answer is we're being careful. Because we have so much instability in the underlying systems.
What I don't understand is you keep saying everything's going to get worse, but then it's not really going to be that bad.
I want to separate financial markets and the financial infrastructure from people who are employed. We have full employment in this country. We have an excess of need for labor over labor. We have restrictive, for us, immigration policies. We have an aging population. We have a period of time where our memory is it's very hard to get employees. We're very reluctant to part with employees. All of that speaks well to underlying demand from the real economy. On the other hand, we've just been through this incredible period of time where everything levitated and it's not yet at the ground.
Okay, so how far are we away from the ground and how far is the ground from us? That's both a timing and depth question.
Look, this is, I'll turn it around in a question. Take real estate. And I know there are probably lots of people in the room who have a view in real estate, but let's not argue whether real estate is good or bad or office or anything else. The typical deal done at a 5% cap rate in the last 10 years, I think cap rates have moved 300 basis points. The pure math means your equity is worth 6 cents on the dollar. That's the pure math. And if someone says, well, that's not my real estate is growing 10% a year. Okay, you're right. It's only worth 22 cents on the dollar. And so you look at the public stocks, you look at 3 really good real estate companies, SL Green, Vornado, and Paramount, their stocks have been decimated. You look at people's holdings of real estate, and everyone's off 5 or 10%. I think we have a ways to go in terms of the correction. I think we have a ways to go in terms of growth. I think very few things other than public marks have adjusted.
Okay, well, let's talk about then, when you think about the private marks that haven't adjusted, when does that hit? Who does that hit?
I think it hits everyone. I mean, if you think about the asset classes that adjust, fixed income adjusts first because you're talking about rates and duration with very little judgment for credit. And so by and large, I think fixed income has adjusted. Traditional equity, which has lots of comparables, I think also has adjusted. I think the asset classes that have not adjusted are real assets and growth. Those are the two places where you either have unique companies that are held at unique valuations.
But effectively, you're saying that the private markets are, let's get honest, are you effectively saying everybody's mismarking their books right now?
I don't say mismarking. I say there are conventions. So for the most part, the real estate market, as an example, marks their portfolio against an index. That index is backward looking. It's called NCREIF. And on the way up, it undermarked the gains they had in their portfolio. On the way down, it's slow to mark the portfolio. Is that mismarking? No, that's the convention that everyone who is in this market understands that we do. But investors also understand that's how it's marked. So if they have opportunities to withdraw their money at higher prices than are going to be in 2 years, they're going to do that. And they're not unique. You take in the industry in which we participate, in the retirement services or the insurance industry, we look back 3 years on real estate valuations. These are conventions that were designed to smooth as opposed to, quote, made up.
Okay, so then there's a larger question, which is, you said designed to smooth. Are these the right conventions for the moment?
I don't know about right or wrong. It depends what we're trying to do. If we're looking on what's it worth on Tuesday, no. If we care what it's worth over a decade, probably.
Okay, I want to ask you about the implication for the banks in just a second, but you mentioned SL Green and Vornado and a couple of the other public companies where we've seen those stocks decimated. Do you look at that and say, okay, actually, there's value there now?
I don't look at it that way. It's not, real estate is not the strong suit of what I do or of Apollo, and you need to have a fundamental view on office because most of those declines are being driven by office. But I think we have to take stock of, I'll just say fundamentals. So I look at where we are at 9 West 57th. $110 a foot in our floor. I look at Greenwich, $114 a foot. I look at LA, $105 a foot. I look at Miami, $90 a foot. Class A office rents in Chicago, I think they start with the 2 today. So,
but talk us through then the domino effect. I think there's this expectation. I don't know if you think it's Q4. I don't think it's Q1. I don't know when you think it comes, where all of a sudden these regional banks, which have this exposure, and maybe others in the private market, I want to talk to you about that, all of a sudden actually have to mark their books. Everything gets marked in a new way. And all of a sudden we're talking about a completely different crisis.
Remember, regional banks are not equity investors in real estate. They are lenders. By and large, lenders will be okay in this cycle. That doesn't mean every lender. That doesn't mean all the time. That doesn't mean people who would need liquidity at a certain point in time. In this cycle versus the 2007, 2008, 2009 cycle, actually most of the pain of this cycle is going to be borne by equity rather than by debt. Regional banking is another issue. Regional banking is a mismatch of assets and liabilities. You have long-term illiquid assets, which are funded with deposits. Historically, that's been a relatively safe practice, particularly for government guaranteed deposits. But just like we had an election with full-on social media and we got a surprise, we've just had a banking crisis with full-on online banking. And guess what? $42 billion can leave a bank in 4 hours without a line. It's not a US phenomenon. This is a worldwide phenomenon.
Okay, so if that's true, and I've been spending too much time thinking about this issue, ultimately is the banking business as we know it fundamentally broken, which is to say that if the deposits really can leave that fast, there is no way, there is no plausible solution I don't see to insure those deposits unless you are going to let all of that money sit in those banks, and what that ultimately would do to the rest of the credit system in America and everywhere else, and economic growth would be even worse. So what do you do?
I think about shading rather than, cataclysmic results. I know it's not as interesting, but I do think that on the margin, banks will not be as good holders of assets. but this is by design. I mean, if you think about where does credit come from? How much credit do we need? Credit is related to GDP. In 2008, the financial markets were staring into the abyss, and regulators, government, the industry made a fundamental choice. Do we allow credit to be supplied exclusively by the banking system? Or do we democratize credit and have the broad investment marketplace supply credit? Well, they made their choice. Dodd-Frank was in theory designed to restrain the market power of the four big banks. It worked. Banking is less than 20% of credit provision in the US today. And by the way, US capital markets, envy of the world. We're 50% of the world's capital. The government benefits, business benefit, consumers benefit. I just think now with this notion of banking instability, and I do mean instability on the margins, I think we will see a fundamental change in regional banking over time. You know, I think it's Canada that has 6 or 8 banks. We have 4,000 banks. Do we need 4,000 banks? Probably not. And by the way, if you think about the economics of the business, regional banks pay more for their deposits than the big money center banks. They're now going to pay more for debt and equity, at least for a period of time. Their regulatory costs are going up. And now they know that 42 billion of deposits can leave the bank in 4 hours. So on the margin, we are going to see banks become less asset intensive and more capital markets. And by the way, debanking, it's happening in Europe slowly, and it's happening in Asia ever so slowly.
Okay, Mark, you know that we agree on this topic. And yet what you just said, I think for most people is considered sacrilegious in this country. The idea that you are going to effectively get rid of some of the smaller regional independent banks, community banks around the country. And so the question is, okay, let's say you do that. Is there a way then to either incentivize the big banks that are left or the private credit players that would be more that'll be consolidated to actually lend in markets that would otherwise be underserved, let's say?
It's happening. I mean, eventually economics rule. I mean, I don't see us suffering from lack of credit provision right now, other than in some very isolated sectors. There's plenty of money. People may not like the cost because we are all anchored. We're anchored to what's been going on.
Right, no, but so at minimum, the cost is then a lot more.
Well, the cost is more for everything. Again, inflation. We've had interest rate inflation too. That does not mean there's not credit availability. It just means that we're paying more for our money. But, you know, I start with you asked about a fundamental view. Are values low today? No. Are interest rates high today? No. Are spreads wide today? No. Is liquidity? No. Fundamentally, I think we're actually normal. Unfortunately, we've anchored ourselves to a decade of abnormality. And it's taking us and taking consumers and it's taking businesses a long time to de-anchor.
You look at, what do you think your returns are going to be like over the next 5 years? What do you, and not just Apollo's, but what do you think the average returns in the world will look like or should look like?
For what?
Call it equities. Let's go equities or blended. Look, we have some pension fund managers in here who have to make their numbers because they got to pay out some money, and they're all trying to figure out how much money can I reasonably expect that I can actually make in this recessionary environment that you're trying to describe.
We had a tailwind when we print $8 trillion and when we take interest rates from high to low, near zero.
Right.
Everything levitates. And you can extrapolate that and say that was my investment acumen, or you can take it for what it is, which is levered market beta. I think that tailwind no longer exists, and we will see lower rates of return for equities because we just don't have that lift going. If that's single digits, that's single digits. I'm not in the equity market prognostication business. And in credit, we see higher base rates, but in a real sense, I think returns are going to be very challenged. And I'll go further. Fixed income markets, broadly syndicated markets, are devoid of alpha. There's no alpha left in publicly traded or broadly syndicated markets. And there hasn't been for 20 years. And we know this because you can buy this from big asset managers for less than 6 basis points. And we also know it because 93% of active managers have failed to beat the market for 20 years. That's a beta market. So if you want to be liquid in public markets, you're getting beta. That's not bad. It just means that's what you're getting. And by the way, I'll flip to the equity markets now. In the equity markets, 60% of the market is now ETFs. 80% of volume is S&P 500. 5 growth stocks are 25 to 30% of the S&P. We are essentially all levered to 5 growth stocks in the Fed. And 85% of active managers have failed to beat the market for 20 years. I would say that is a beta market too. So where's alpha? And this is the self-serving commercial. Alpha is not in publicly traded markets. Alpha means you need to step away from publicly traded markets and be in less liquid in private markets. And that's essentially the business that we've built and the tailwind.
Let me ask you, I mean, you're a publicly traded company, but let me ask you a policy question. Is that a good thing? Is that a good thing that the true only opportunity for most Americans, which they don't really have access, but is to the alpha you're talking about, is in the private markets?
I'm not going to say good or bad, but I'll make a policy statement, and I have no problem doing it because I say this publicly all the time. We take people who need returns the most, people in their 401k in retirement, right, and we force them to be daily liquid for 50 years. What we're doing makes absolutely no sense because we have this mistaken belief that public is safe and private is risky. That's just not true. Public is safe and risky, and private is safe and risky. The only thing that's different is a degree of liquidity, and we haven't adapted to the financial system the way it is. So I'm going to soapbox for 2 seconds because I do think you need to get these things on the table. So I've already said I think public markets are all beta. The second is one of liquidity. One of the other changes of Dodd-Frank was to penalize dealer capital. Dealers hold as securities 10% of what they held in 2008. Markets are 3 times their size. There is no liquidity in public markets on the way down. There's only liquidity on the way up. We just saw this in UK LDI in the fall. LDI was not some crazy bet that UK pension managers were doing. It was a mistaken belief that you could sell AAA and AA obligations at market. And they tried to, and it went down. And they tried to, and it went down further. And then they started incurring losses. And I know that because we were a third of the market for 2 weeks as a market maker. And we're not a market maker. But things got so wide that we stepped in to make a market. I think that we have overvalued liquidity. We have not appreciated that public markets are mostly beta. We don't fully understand that the banking system is not the primary provider of debt capital in the world. And we haven't really adopted to this notion of where risk is. And what is risk? Risk is not being private. Where does return come from in the investment marketplace? So last soapbox, and then I'll be quiet. You can take duration risk. You can take credit risk. You can take business valuation risk. You can take startup risk, or you can take liquidity risk. How many investors need 100% of their money on Tuesday? None, or almost none. So for a portion of their portfolio, not their portfolio, why not get paid for something that is not a real risk? Less liquidity.
Okay, so you had Jay Clayton join your board as the chair about 2 years ago now.
Not only did I'm the luckiest CEO in America.
Jay Clayton, of course, ran the SEC, and before that was at Sullivan & Cromwell, and I believe he's still a senior counsel there now.
Yes.
I raise his name because I wonder, and maybe it's your future job in life, but if this is your view about policy, how you think you could effectuate that policy to change the way investments work in the United States? And what he says when you guys, I'm sure, sit around chit-chatting about this.
Look, I say what I say in here and in public. I think it will start with high net worth investors and family offices, and we will see a trickle down over time. I tell family offices and high net worth investors that I expect 50% of their portfolio in the next 5 years to be in alternatives. And I hear like a gasp from the audience, like 50, they're at 8 today or 20 today. And then I remind them that the definition of an alternative is not what they think it is. It is not private equity or hedge fund or some sort of fund. It's just an alternative to publicly traded stocks and bonds. And alternatives actually exist from AA to equity. And we just don't think that way because we think private, alternative, risk, public, traded, safe. And if 22 didn't teach us anything, you look at the decimation of the growth stocks, not down a little, down 70, 80, 90%. We have to have gotten an education that public can be risky. Private can be risky too. They're not the same gradation anymore.
Let me ask you a question about investing. In the 10 minutes that I was at the sort of cocktail hour before this began, at least 3 different people, including a good friend of mine, mentioned ChatGPT to me and AI. And it raised to me the question as to what it is that you think all of these people in this room are going to be doing for a living in 5 years from now, in terms of how you think investing gets done, how AI changes it, if it does at all, how many employees Apollo and the way you think about sort of the employment and partnership looks like. Are we talking about a fundamental rethink of all of this, or is this some kind of hype cycle that we'll be laughing about in a year or two?
Look, hard to know, but right now, AI, ChatGPT is the first draft of everything. It is a huge productivity saver. It's not just the first draft of memos, it's the first draft of code.
Are you using it?
Yes, of course. This is great. I'm always in the business of trying to simplify what we do. And for some reason, people think what we do is complicated. I don't think it's complicated, but people think it's complicated. So I keep saying to marketing, simple, simple, simple. I don't like what I get back. So I type into ChatGPT, give me the Apollo strategy in Dr. Seuss. And 15 seconds later, I get a page and a half of fabulously simple Apollo strategy. I send this to marketing. I'm like, now you have your first draft. And that's what we do.
Have you issued the poetry yet?
By the way, I'll send it to you afterwards. It's actually great.
Do you think it actually changes the game, if you will?
I think it does. I think it's a massive productivity saver. I can envision all sorts of uses. I have a hard time because of my limited technological intelligence, understanding that this is going to be the final decision maker in anything. But I can see this being an incredible first draft of everything.
Okay, but then let me ask you this. When you guys think about hiring plans over the next couple of years, it used to be that you'd have maybe an investment manager and they'd have a deputy and maybe they'd have 3 or 4 analysts who'd help them. Do you now say to yourself, I don't need those 3 or 4 analysts, or I need 2 analysts now, or I need 1 analyst, and basically I just need the investor and ChatGPT, and that's the end of it?
ChatGPT is one tool. Blockchain's another tool. There's so many tools. All the businesses that are knowledge-based businesses are going through this cycle, and it is clear our business in the future will be less labor-intensive per unit of assets than it is today. I have no problem recognizing that.
So
how much so, I can't tell you.
Okay, so about hiring plans for Apollo this year compared to last year with the advent of ChatGPT, any different?
Totally unrelated. We're so early in the cycle to know. I mean, our business is being driven by completely different fundamentals at this point, and ChatGPT is, the next 5 years.
But in a way, it also then goes back to the topic we were talking about, which is office and real estate, which is to say, if you actually think it is going to change employment, and therefore you need even less office than we think we need already, what does that do to the rest of the system we just talked about?
Well, we're seeing it. I mean, it's reflected in pricing on the margin. Yes, people are using offices less. We are an in-person culture. Having said that, well, there's a lot we can do on Zoom or its equivalent.
But you have people in 5 days.
We've been back for 2 years.
5 days, 6 days, 7 days?
Whatever's required. The answer is you come in as often as you need to come in. But we're in the office, but no one's ever been in the office for 5 days. We're out traveling. We're visiting clients. We're visiting companies. We're in the field culture.
Can you imagine yourself wearing an Apple Vision Pro?
No.
No.
That's just me.
You mentioned blockchain, but let me ask you a separate question that actually relates to crypto, because interestingly, my understanding is that you guys actually hold some cryptocurrency on behalf of clients. I believe Apollo does a little bit of that.
I think it's inaccurate. Look, there are lots of diverse viewpoints within Apollo. As I've said publicly, I don't see the use case.
You don't see the use case?
I don't see the use case.
By the way, this is through a partnership with Anchorage Digital.
Okay. Storage of digital assets is totally different than crypto.
But you have no use for Bitcoin, no use for Ethereum, no use for any of it.
Me personally, I don't see the use case, and Apollo is not in a significant way. But make no mistake, the rails and the technologies that were being built to support that are going to have massive change in our business. And by the way, the same I think is true for gaming. What's happened in our industry is everything that's associated with money, crypto, has been the subject of regulatory scrutiny. The same ecosystem is being built in gaming, and it's not subject to regulatory scrutiny. And you can think of the use cases. I mean, think about what we do in the US to sell a car. How many have sold a car in this room? Everyone. We go look for a piece of paper, if we can find it, called a title. Then we sign the back of it. Literally, there's no notary, there's no nothing. We hand it to the other person, they go and register that. Why? I mean, why do we pay for title insurance? I mean, I do think we're going to see a revolution in financial markets as a result of new technologies, but I don't think it has anything to do with crypto.
Right. Are you a believer? You saw the news this morning. We were just talking about it, about Coinbase. Both the lawsuit against Coinbase, we saw yesterday, the lawsuit against Binance. Are you of the view that this eventually goes away? We don't talk about it.
No clue. No clue.
And you don't have you have a negative take, but you don't have a thought about where this goes.
Look, I'm not a casino gaming person either. Like I don't play the lottery. So the fact that I don't own crypto shouldn't surprise you.
Let me ask you a different question just about the advent and shift of what Apollo is today. And maybe you could explain to everybody a little bit about Athene, because I think that's sort of a huge shift in what the firm is. And I think oftentimes we think about Apollo in the context of private equity, but it really is something else entirely.
So we're in two businesses. One is the business that people don't know we're in, which is retirement services. And retirement services is Athene. And essentially in 2008, we put $16 million into a shell, and that business is now $350 billion. And it is an insurance company, but it is not a traditional insurance company. It doesn't insure your life, your health, or your property. The only thing it insures is your retirement, and essentially your pension through annuities or through pension guarantees. And the way we make money is we earn more on the assets we hold than on the liabilities that we pay out. We make spread. But we're also very large and very safe. So 95% of our portfolio is fixed income and 5% is equity. And 95% of that 95% is investment grade. But I've already said, I don't think there's any alpha left in publicly traded markets. So for Athene to be successful, we've had to become a prolific originator of private investment grade. And that's what we've done. So now I flip over to the Apollo business. The Apollo business is $600 billion of asset management. $300 billion is for Athene and Athora, its European peer. And $300 billion is for clients. It's managed side by side. It's all managed in one strategy. Purchase price matters. It's all aligned. We're almost always the largest investor in what we do. But if you think about the business, $450 billion of that business is credit. Mostly investment grade, which Apollo investment grade, that's not the normal way people think. 75 billion of that is traditional private equity. And 75 billion of that, I think I'll call hybrid or hybrid equity, which is the midpoint between debt and equity. And if I think about the market going forward, all businesses are going to be larger because I think private is going to grow at the expense of public because of this alpha beta dynamic. But I look at businesses that are scalable and not scalable. I look at our private equity business. It's at scale. We've been in business for 33 years. It's an amazing business. It's an engine of the firm. It's going to be larger, but not much larger in 5 years. There's simply no benefit to scale. In fact, I might argue that there's a detriment to scale. On the other hand, I look at the private credit business at 450 billion. It sounds big. It's not relevant. In the scheme of those markets, we don't exist. And I think that's amazing that we're a $450 billion business in a market where we're not relevant. And I think it'll be twice its size in 5 years.
You say you're not relevant, but we often talk, or regulators talk, or policymakers talk about the idea of the shadow banking system. And they would say that you are the shadow banking system.
Actually not. There's this great thing. So after COVID, there's an FSOC report, and it says shadow banking, the looming crisis. And that sounds pretty ominous.
It does.
And you flip the page, and who's a shadow bank? Open-ended mutual fund is a shadow bank. A pension fund is a shadow bank. Investors of all insurance companies are shadow banks. And the question is that good or bad, or is that policy design? We had a choice in 2008 to follow the European system. The European system essentially is a bank-dominated capital markets. There is no real capital market other than equity and bank in Europe, in Asia, and elsewhere in the world. And we instead elected to democratize this notion of credit provision. Are we better or worse off? I think we're better off. We're the envy of the world. Everyone wants what we have. We have this amazing strategic advantage. Some would say a strategic weapon. We are 50% of the world's capital. And yes, we have issues of mismatches. So where do we have mismatches? Well, we have mismatches where people have borrow short and lend long. The banking system, we've just seen what happens when you have mismatches. Government is taking steps to correct those mismatches. Open-ended mutual funds, daily liquid. Okay.
You think that's a big mismatch?
I think it's a mismatch. Whether it's a big mismatch or not, time will tell. An institutional investor in a pension fund who has a 20-year time horizon, do they really care? As long as they make fundamentally good credit decisions, they are holding and they're counter-cyclical. For the most part, insurance companies, retirement services businesses, locked in long-term liabilities, holding counter-cyclically. And so shadow bank, non-shadow bank is really not the issue. People will often say to me, well, this thing is very risky, but is private investment grade riskier than public investment grade?
Well,
I don't think so.
It may very well not be. The one thing is you don't have regulators looking over your shoulder at the same degree and level with which the big SIFI banks do today.
Do I borrow at the?
And I'm not saying that's a good thing or a bad thing. I'm just saying that's what it is.
I was in Europe 10 days ago and I sat down with the CEO of one of the largest European banks. And literally, we'd never met before. It's a blind date. A blind date is sometimes fun. So I'm there and I said almost nothing. And I got a 15-minute lecture on how we're the beneficiaries of regulatory largesse. There are 15 people in the back office. There's no control, shadow bank, blah, 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 blah. And I said, are you done? Mm-hmm. And then I said, okay, my balance sheet is much higher percentage of investment grade than your balance sheet. Second, I've spent $6 to $8 billion over the past decade while people have been chasing growth, building an origination engine. Third, I do no maturity transformation. Everything is perfectly matched. And finally, I hold more equity capital as a percentage of assets than you do. I hold more tier 2 as a percentage of assets than you do. And if you want to see my portfolio, actually click the website and my portfolio is online. So if you're done, now we can have our meeting. And that is my fundamental response. When we hear shadow banks and we hear the market and risk, 90% of the use of the term private credit is inappropriate. Private credit in journalistic parlance, business journalists, means levered lending. Levered lending to buyouts. If we got this table right, and we put them in business, they would need this table and money, and we could be in the levered lending business. Because levered lending is lending to transactions by financial sponsors. The financial sponsors self-identify. They announce that they've done something. Eric or David pick up the phone and they go call them and lend them money. That is not a business that has long-term barriers to entry, but it is what the press is fascinated with. And the notion of banks losing share to this table. But this is a single B. This is a risk asset. Sometimes it's a good risk asset. Sometimes it's not such a good risk asset. That's not what I'm fundamentally talking about. What I'm talking about is the daily business of lending against equipment, lending against receivables, lending against aircraft, lending against real estate, and so on and so on and so on. That is the private investment grade market. And when I visit clients and regulators, I ask provocative questions like, is a single A private credit an alternative? And people look at me like, huh? Like, no one's even thought about this before.
Let me ask a maybe the provocative question, which is the perception that, and I'm not going to say Apollo specifically, but firms like yours, as a lender to some, are considered sharks. And I say it in this following context. There's a view that if you go to a bank, they want to work with you, or may not want to work with you, but if they do, and you miss your payment, the guy's going to call you up. He's going to say, look, you missed your payment. I want to work with you. They have no interest in owning the asset. They would actually like to give you some time to figure this out because they don't want to have to deal with the mess that you just made. The perception is that if that you've lent me the money, I missed the payment, you're going to call me up and say you missed the payment and thank you for playing. Good luck to you. We now own the asset and we're very happy to own the asset, by the way, and we've now taken it from you. Goodbye.
So $525 billion of our $600 billion business wants you to make your payment. If you tell us... Say that again? $525 billion of our $600 billion business.
So it's that other portion that doesn't want the payment being made.
And that's the private equity business. So like, you think about the collaborative, in the private equity business, there's a winner and a loser usually. It's zero sum. Someone buys the asset, someone loses the asset. Sometimes the winner is the loser, but that's a whole nother story. But it is a competitive business. And a small portion of private equity is distressed. So a fraction of a fraction, $525 billion is the provision of loans. If we were in the business that you've just described, I doubt we would be a $525 billion business on our way to $1 trillion business in just lending. The reality is we are flexible. We are responsible. We hold these things long term. Remember, banks don't hold your credit. When you take a loan from a bank, the bank holds a small piece of it and syndicates it. Mm-hmm. When you take a loan from us, we hold a big piece of it. And therefore, when you need to come back to us, we generally are there to make modifications. And the business is very different than the perception. Will I say that that is the perception? That is the perception. I mean, I take for granted, or sometimes we take for granted, that people know who or what an Apollo, a Blackstone, a KKR, a Carlyle is. None of us know. None of any market does not know who we are or what we do. The firms are all quite different. And it is up to us now over this next period of time to actually change the perception for the reality of what the business is. We are primarily an investment grade provider of private credit. I have no problem with that as a business description. Yes, are we competitive in the private equity business? Absolutely, we're fiduciaries for clients. But better than that, our largest borrower is actually our largest competitor.
Which is?
No naming of names in client side, but in that business, we want 25% of everything and 100% of nothing because we want to be diversified. So if you think about what Athene wants, Athene may want 25% of everything we originate that's appropriate for them. I have no problem syndicating credit to the direct competitors of Athene, and I do all the time. They're our largest clients because they know.
So Blackstone.
Traditional insurers. Think of mutuals.
Right.
Think of the name brands in the insurance industry. We are a provider of alpha. We own it for our own balance sheet. Therefore, we're not coming to you as a broker or a banker. We know how to put things on regulated balance sheets. And once you figure out that we're in that business and we're not just selling an asset to you, you step back and you say, well, purchase price matters. They're fully aligned with us. Excess return per unit of risk, which is what an alternative is. That's how we've gotten to be a $600 billion business.
I want to open up to questions in just a moment, but I have a couple personal questions for you. I want you to explain this to me, if you could. So you are part of what I would describe as the Drexel diaspora. And I'm hoping you can talk about this sort of generationally, what you think happened. Because I'm thinking of David Solomon. Here are the people who now run Wall Street. David Solomon, Rich Handler, Bennett Goodman, Ken Moelis. You guys know all the names. What do you think?
It's a long list.
So explain what you think you learned then that has led to this now.
So if I go back and I think about the choice I made in 1984 coming out of business school, so 39 years ago, which I can't remember much else. But 39 years ago, the notion of what Drexel did versus what everyone else did, I had very little interest in learning about whether Exxon could borrow at X or Y or how to optimize Exxon's borrowing. I was much more interested in whether the high yield borrower, whether their business made any sense. It actually forced me to try and understand business rather than financial markets. And
you think this was different at Drexel?
By the way, completely and totally different for the way the market existed back then. Let's remember where we were. There was no high yield bond market. There's no levered loan market. There's no securitization market. There's no ETFs. We take all these things for granted like they sprang from the ground. All of these things were created. And so for the most part, for the Drexel clientele, you were doing things of first impression. You were thinking about solutions. And I was fortunate enough to actually have the experience of working for Mike Milken. And I thought, young hotshot coming out of Wharton, it was great. I knew the answers to everything. And in fact, I was actually naturally good at this. Mike would walk by my desk every day at the end of the day, would ask me one question. I think for 100 days in a row, he stumped me. And he wasn't doing it to show me how.
Was it a different question each day or the same question?
Well, you'd think I could learn. No, but he was actually teaching me to think about things differently. He wasn't asking me about the deal. He was asking me about something else that was tangentially related to what I was doing. And I do think this notion of questioning, of creating, of asking really fundamental questions, of thinking about how markets work and not just taking observed data is what has led to this group being successful, because I think those are traits that breed success.
Okay. Let's talk about you getting this job. You didn't want this job originally.
No, you read the press. You can't believe the press. You know that already. That's just not the case. Look, it would be very straightforward. 3 people have a hard time running anything. And so...
And we're talking about Josh, and we're talking about Leon, and we're talking about you.
But the 3 of us couldn't run anything, or you and I and David couldn't run anything. It's very difficult in a business to have 3 people who are responsible. That was the nature of what we had. And about 10 or 12 years ago, I sat with my 2 partners and I said, okay, 3 of us can't run anything. I'm happy to run it. You two go back to work. Alternatively, Josh, you run it. And Leon, I'll go back to work. And third, Leon thought I was going to say he runs it, but I know that wasn't going to happen. Third, we can hire someone because Leon, while a great strategic, was not going to run the thing day to day. And Josh raised his hand and said he was going to run the business. And by the way, at that point in time where we were, it was probably the right place. We were just filing financials. We were just creating systems. We were building the infrastructure. And I said, okay, great. I'm going to go off and build this little insurance thing called Athene, which, by the way, is now half of our business and forced us into the capital markets business. So when Leon stepped away from the business in October of, I think, 20 or 19, there was an opportunity for me to run the business. I was always willing to run the business. I just never thought I could be effective doing it in a triumvirate or in a two-headed structure. But the chance to run the business, why not? Like, what's more fun than this? Literally, we're actually living in incredibly fascinating financial markets. I've run every part of this business previously. As much as when it started, I used to go up to purchase on Fridays and do the wires and back office. So I've seen all the pieces of it. Perfectly happy to run the business, just not in the structure it was.
Without being purient about it.
Period.
No, without being purient about it, how have you, as you're leading this company and reading lots of headlines about your former colleague, Leon Black and Jeffrey Epstein, how have you thought about that? How do you deal with it with investors? How do you deal with it with your employees? What's your impression of it? I imagine you wake up some mornings even still and read stuff and say, oh. So
straightforward. People make choices. And Leon, it's already said he made a bad choice in his association with Jeffrey Epstein. And that has, in the market we live in, disqualified him from running the business. And he stepped away. And I think if you asked him, he'd say, it's unfortunate, it's a mistake. And he's very happy to have me running the business. But internally in employees, we were going through a shift. And it's not an investment shift. The investment side of the business always worked perfectly. And it still works exactly the same way. We are a very contrarian culture. We allow for minority points of view. It is a really good investment process and culture. But when you run a PE shop, you make 10 decisions a year and the rest is ceremony. And that allows for centralization of decisions. But as the business got bigger and bigger, you can't do that. You actually have to go and articulate a strategy and make it public and make it so the employees know where they're going. You have to articulate the culture and cultural norms and what people can and can't do. And then you have to back them up and create a culture where people can fail, admit failure quickly and fix it. If I'm right 70% of the time, that's a lot. But I'm fast to recognize when I've screwed it up and we fix it. And by the way, that's what we're doing. And the job is, it's a lot of work, but it's not that hard. Because it starts with, what do we offer our clients? We offer our clients only one thing, and that's judgment. And judgment comes over a long period of time, seeing what we do and don't do in a variety of markets. Therefore, if you're at the firm, I want you to spend your whole career there. So my North Star of everything I do internally, I want to make it the single best place to be a partner in financial services. So you spend your whole career there. And if it were one thing, I would do that one thing. Unfortunately, it's like 100 things. It's not like every day is what we do.
Final question from me, and then we'll open it up. More fun now running this company where you have lots of other pursuits, which maybe this audience knows about. I don't know. You own Duryea's. You own 2 restaurants, which a bunch of people here go to. You were involved with Jimmy Iovine with Beats at one point. Maverick Carter and LeBron James, Spring Hill, your investor and on the board of that production company. Back in the day, you were involved, I think, helping bring Howard Stern to some degree to Sirius. You like this sort of extracurricular stuff? Where does that land in the portfolio of life that is Marc Rowan?
Look, I've been fortunate that lots of people have made me look good in every one of these things. So I'm not a sports fan, so I don't collect anything. There's not a single thing I collect, but I do like to build things. And so Duryea's, et cetera, is an outgrowth of my general contracting sideline. Everything else, I met Jimmy Iovine in a meeting 25 years ago in Paris. Jimmy wanted to raise money for Beats. He happens not to like financial people. Jimmy said to me, could you raise $80 million and not have me speak to any investors? I'm like, okay. I did. I went to 2 board meetings. I said nothing. He sold it to Apple. That's good. And the rest, again, it takes very little of my time. This is what I do, but I'm interested in lots of things.
Marc Rowan, everybody, thank you.
Thank you.
Thank you very, very much. I think we have a microphone in the back here, and I know there's a lot of folks who have much better questions than my own, so please have at it. Right here.
Thank you, Andrew. Baldas from BGD Holdings. Curious to get your thoughts on a point you touched on. In a general environment, when you look in advanced economies, there are more folks getting older than there are younger folks working, and people generally are living longer. Where do you think is the retirement services, how equipped are they to meet the needs of the folks that are getting older and living longer? And this is from a macro standpoint.
We're not very well prepared at all. I mean, the question is really about retirement services. So there are places around the world who are doing a reasonable job at this. I would say Australia is doing a reasonable job at it. Israel is doing a reasonable job. And Mexico, if they stay on the path they're on, is actually doing a reasonable job, which is to recognize that the government is not likely to provide what they need in terms of retirement savings. So they've forced market-based alternatives to retirement savings, which not only have been good for employees, but they've been good for the economies as a source of funds. Think of superannuation funds and other sorts of vehicles. In the US, if we had invested Social Security in anything other than what we did, which was treasuries, we'd be talking about Social Security surplus, not Social Security deficit. So I now look at retirement services, of which we are the largest factor. And it's the beginning of my talk to regulators. So we have a business that serves retirees, and last I looked, the world is getting older. We produce retirement income. And so you would think that we are, as an industry, in a growth industry, yet the industry has not raised any capital for a decade. And in fact, has paid out most of its capital, 100% of its capital base in the form of dividends. And investors do not value these companies highly. So if I were a regulator interested in consumer solutions, I'd kind of step back and think about whether the regulatory regime is actually one that allows for that. In the US, I think we have time and we have a chance. In Europe, the availability of guaranteed retirement products is down almost 50% in a decade, and I believe it's linked almost exclusively to regulatory change. You have an industry where the large players are getting out because the fundamentals of the market, you used to be able to find alpha in publicly traded markets, and now you can't. So you can't just outsource your money management. You either have to build internally, and historically retirement services companies, insurance companies have not been good homes for asset managers, or you sell your business. And the vast majority of the large players have elected to sell their business and to withdraw capital. And the rest of the answer will take the rest of lunch. So I'm going to stop there.
I think there was another hand right there. Right here.
Just quickly on going back to the banks at 4,006 in Canada, which I don't disagree. A lot of M&A should happen there. Do you think it should happen within the banks consolidating, or do you think private money should come in, which then in turn would force some of those private entities to become regulated?
I don't think there's any forcing to be done. I think it's incredibly unlikely that any of the private entities will step forward to be in the banking business. I just don't see it. I think economics will ultimately lead banks to conclude that they need to be larger. I don't mean larger or small. A local community bank probably has a niche that is irreplaceable and inaccessible to the vast majority of other financial institutions. But if you find yourself in the middle, you're bearing the regulatory cost without the advantages of scale. I can't believe that economically that's going to be a good place to be. And once the dust settles, I think on their own, we will see banks consolidate. I don't think it's going to require any government action. I don't think it's going to require any private capital. Most of these are done equity for equity.
And just lastly on that point, back in 2008, Lehman went under, so then Goldman took a bank charter. Jefferies, I believe, all the other brokerage houses became bank charters just because they had to at the time due to the bailouts. So you're saying that nobody's willing to step into that, and I'm not putting words in your mouth, but just because they don't want that oversight of the.
I don't see it as a desirable outcome And I don't think others do, to my knowledge. And also the business is not such that you require funding. Remember, these were businesses that were transactional. They were investment banking businesses. They were running balance sheets, but they didn't have deposit funding. That's not the business that any of us run. We run match funded businesses with long-term assets, long-term liabilities.
Thank you.
I think we're going to sneak in one more. We'll try to get to you, I think, if we can.
Thank you. Elena Kowalska, Chief Trust Officer, SAP. Mark, I'm curious to get your view on a lot of the digital transformation trends. So, of course, the AI and the disruptive technologies are very much impacted most of the industry. So I'm curious about your outlook on how this is going to change your business and your industry.
So I start with our business is a $600 billion business built $5 billion at a time. And I think that's our whole industry. And what I mean by that is none of us knew how fast we were going to grow or how the business was going to develop. And we had a critical mass of smart people on the investment side of the business. And what we've done over the last decade is we've built a critical mass of smart people on the non-investment side of the business. And so you're watching us all get to scale and operational efficiency with the advent of newer technologies. And so we're in some ways the beneficiaries of our own delay. And so I think it is going to be transformational for our business. I don't think, as I say to the team internally, I don't think it's going to result on us retrenching unemployment. I think it is going to slow down the rate of growth. Historically, if we wanted to grow, we threw 100 people at it. And now I think you're going to see in some of our departments, we're going to get to scale this year and next year. And we've said publicly, we're going to try and deliver operating leverage over the next 3 years.
We don't have time for one more question? Let's sneak that question in if we can. You're the finale, sir. Make it great.
Hi. Hi.
Pressure's on.
You talked about commercial real estate and the shift that has occurred in the office space, et cetera, through COVID and the remote work. What are your thoughts on residential real estate and any shifts occurring there in your view in the near future?
Look, I'll first, I wanted to say thank you for the time today. I hope I've had something worthy to say, given who else has been up here. So I do stand in awe of it, and thank you. Now I come back to real estate. I think the perception is right that we are underhomed in the U.S. And we can debate whether it's as a result of regulatory shifts or building costs or any other metrics that we have. But I continue to think that while residential will cycle, the underlying patterns of fundamental demand and the need for housing is going to support the market. And that's really what I want to be clear in real estate. I think there are problems in real estate as a result of patterns of demand shift, particularly in office and a little bit in retail. Everything else, it does not mean people pick bad real estate. It just means if you bought a bond, in 2020, and now in 2023, it's worth less just as a result of interest rate. For much real estate, it's a long bond. It's just worth less. And in most real estate, it's bought on leverage. So it magnifies its impact on the outcome on equity. That does not mean it's all going to come due at once. It doesn't mean all the loans are being called. This is going to be a decade-long transformation. I think on average, you'd rather be industrial than anything else. You'd rather be warehouse. You'd rather be residential. You'd probably prefer not to be office in Chicago or San Francisco right now. So thank you very much.
Marc Rowan, everybody. Thank you. Thank you.
Really appreciate it.
Really appreciate it. Thank you. That was terrific.
Excellent. Thank you so much, Mark and Andrew. Just a terrific conversation, loaded with insights. I want to just mention next up, we have Karen Carnial-Tambor, the Co-Chief Investment Officer at Bridgewater. Following that, we're going to be hosting Mark Zandi, Chief Economist at Moody's. And then we will have on July 12th, actually in July, one of our member peer exchanges, which is an event focused on, is it time for school choice in New York? So please be sure to keep checking our website. We're working on putting more events in all the time. And as always, we take a moment to thank the members of our Centennial Society in the room whose contributions help to ensure that we're able to deliver the programming that we do. So for everyone attending virtually, thank you. We'll say goodbye. See you next time. For everyone in the room, please enjoy your lunch. Thank you.